The Little Book of Common Sense Investing by John Bogle introduces a straightforward, powerful approach to investing, using low-cost index funds to achieve market returns over the long term. Bogle, the founder of Vanguard Group and creator of the first index mutual fund, champions index investing as a low-cost, efficient, and dependable method for individuals to build wealth without the risks and expenses associated with active fund management. Key principles and strategies. The power of owning the market through index funds. Bogle asserts that index funds, which hold all the stocks in a market index, like the S&P 500, are the most effective way to capture market returns. These funds don't try to beat the market. Instead, they simply match its performance, providing broad diversification at a low cost. Example: by owning an S&P 500 index fund, an investor effectively holds shares in 500 of the largest U.S. companies, diversifying across industries and sectors, thus reducing the risk associated with individual stocks or industries. The impact of costs on investment returns. One of Bogle's central themes is the importance of minimizing costs. Fees for fund management, brokerage commissions, transaction costs, and taxes can significantly erode returns over time. Illustration: a 1% annual fee might not seem high, but over 30 years, it can reduce an investment's growth by over 25%. By choosing low-cost index funds, which typically have fees as low as 0.1% annually, investors retain more of their returns. Compounding over time. Bogle highlights the magic of compounding. Reinvested dividends and capital gains create exponential growth when left untouched over time. However, high fees and frequent trading can severely diminish compounding benefits. Example: an investment compounded at 7% annually will roughly double every 10 years, while fees slow this compounding significantly. Index funds help maintain the power of compounding by minimizing costs and allowing returns to grow uninterrupted. Why active management fails to outperform. Bogle explains that most actively managed funds fail to outperform the market due to high fees, frequent trading, and market timing errors. Even the few funds that do outperform rarely sustain their success long-term. Statistics. Over a 10-year period, nearly 80% of active funds underperform their benchmark index, largely due to fees and the inability to predict market movements accurately. Bogle argues that rather than paying for this underperformance, investors are better off with reliable index funds. The difference between investment and speculation. Bogle makes a clear distinction between investment return, generated by dividends and earnings growth, and speculative return, based on changes in price-to-earnings ratios. He argues that long-term returns are driven by fundamentals, while speculation introduces unnecessary risk. Takeaway: by focusing on the steady growth of dividends and earnings, investors can enjoy consistent returns without the ups and downs of speculative trading. The inevitability of reversion to the mean. Bogle introduces the concept of reversion to the mean, meaning that stock prices tend to revert to their historical averages over time. This implies that exceptionally high or low returns will eventually stabilize, reinforcing the importance of a long-term perspective. Example: during a bull market, stock prices may rise far above their average values, but they will often correct or revert to the mean in the long run. Investors who hold through these fluctuations benefit from the overall market growth over time. Avoiding the helpers, brokers and fund managers. Bogle warns about helpers such as brokers, consultants, and fund managers, whose fees eat into investors' returns. These helpers often make promises of market-beating performance, but, as Bogle points out, their high fees and costs rarely justify the value they add. The Gotrocks parable. Bogle uses a story of the Gotrocks family, who start with significant wealth but lose much of it by paying fees to various helpers over time. This illustrates how fees diminish wealth, and Bogle advises relying on low-cost index funds instead of costly advice. Stay the course. Long-term focus. Bogle emphasizes patience and discipline. He advises investors to ignore short-term market noise and fluctuations, focusing instead on the long-term growth of their portfolio. Market timing trap. Attempting to time the market often results in buying high and selling low. Instead, staying invested consistently and reinvesting dividends allows for the accumulation of wealth without the emotional pitfalls of reactive investing. Practical advice and key takeaways. Use broad market index funds. Bogle advocates investing in broad market index funds such as the Vanguard Total Stock Market Index Fund, which covers a wide range of stocks and ensures diversification. Low-cost advantage. Broad index funds are cheaper than actively managed funds and reduce the investor's risk through wide exposure to the market. Prioritize low costs in all investments. Keeping costs low is the single most effective way to maximize returns. Bogle's research shows that low-cost funds consistently outperform higher-cost alternatives over the long run. Rule of thumb: if two investments offer the same expected return, choose the one with lower fees. Over time, these savings compound, adding significantly to total wealth. Reinvest dividends automatically. To fully benefit from compounding, Bogle advises automatically reinvesting dividends. This reinvestment enhances compounding by allowing investors to earn returns on both their original capital and the income generated by their investments. Avoid short-term speculation. Investors are often tempted to chase the latest market trends or to react to news and predictions. Bogle warns against this behavior, explaining that market timing and speculative trading increase costs and generally reduce returns. Focus on fundamentals. By investing in an index fund, investors align with the fundamental growth of the market and avoid speculative losses. Simplify your portfolio. Bogle emphasizes simplicity. A well-diversified index fund is all most investors need to achieve solid returns. Complex portfolios, while sometimes appealing, often lead to overtrading and increased fees, which hinder growth. Minimalism in investing. Fewer funds mean lower fees, easier management, and more time for compounding to work effectively. Bogle's legacy and final thoughts. Cost matters. Bogle's legacy centers on the idea that costs are one of the few variables investors can control. He repeatedly advises that lowering expenses through index investing leads to better outcomes for individual investors. The investor's responsibility? Bogle underscores the importance of taking personal responsibility for financial success. By choosing simple, low-cost investments and practicing patience, investors can achieve dependable, long-term growth. Long-term wealth creation. For Bogle, the ultimate goal of investing is not just wealth accumulation, but financial security. He emphasizes building a portfolio that supports financial goals without unnecessary risk. Conclusion. The Little Book of Common Sense Investing provides investors with a no-nonsense strategy for building wealth. By focusing on low-cost index funds, minimizing fees, and maintaining a disciplined, long-term approach, Bogle's philosophy aims to help investors capture market returns and achieve financial security. His emphasis on simplicity and low-cost investing revolutionized the industry and continues to offer a roadmap for sustainable wealth creation.